Thursday, the 3rd of August 2023, I took a high risk reward trade and I'll be providing a post trade commentary on it. I was risking 0.25% on this trade, so instead of getting 11% return on the 11 or 1 to 11 RR trade, I instead got 2.75%, which ultimately passed the my funded FX phase 2. I have screenshots of the during the trade and after the trade on Discord. Moving forward, I will begin my second challenge with my funded FX, which is 10k, and I will look to be risking around 0.4%. Surely that should take around half as many trades to pass the challenge. This was my analysis on last week Sunday. I was expecting price to go higher to clear the buy side liquidity and then for us to get the sells up from this FEG on the 4 hour time frame. But price didn't really give us that entry. It literally just took out the London close high, used it as a fuel, as a manipulation, created the high on Friday. Market opening around here. Monday was consolidation, a bit of a drop, and then from there onwards, market just targeted the sell side liquidity. It didn't really give us any structure shifts on this balanced price range, which I was looking to go higher. And I feel like that was the reason was because NFP week, market just wanted to trade lower, and then when NFP came out to give that retracement, which we eventually caught, and that's what I'm going to be doing the majority of the commentary on. So what happened here was we correctly identified the breakup structure, boss, or you can call it structure shift, yeah, and we also correctly identified this liquidity grab above the highs for this day. So these two things were right, but the entries we're looking for, the sales were here. So market didn't give us that, and it just went lower. So we missed the trade, the sales down to areas of discount. For the sake of organization, it is essential that you use the object tree function on TradingView. You can find it at the bottom right hand corner. You can categorize your drawings into groups, and you can toggle them whenever you need, by pressing the I button. For example, I have categorized my wins, misses, and losses, and I normally delete them once I have entered the screenshots on Notion, because TradingView doesn't let you access multi time frame data in the past after a number of days have passed. I will just turn on the missed trades for now. I have a habit of marking up trades, and that happened in the last few days, as if I was there. And this is to trick your brain to thinking you actually took this trade, therefore it will train your eyes to see similar trades in the future. For example, on this particular day, we've created the Asian range, the market traded above it, creating a fair value gap. Before it does that, we traded above it, taking the buy side liquidity. We dropped beneath, creating relative equal lows. Therefore, we have this range from the high to the low. We traded higher, taking out the short-term high, manipulating the short-term high right there, tapping into this fair value gap, and I believe it is balanced price range. Tapped into that, dropped, and then the subsequent break of structure beneath that wick right there, that will be considered as a break of structure, and then we trade higher into the body of this candle, this up close candle. In this case, you will not be looking to buy it from this FEG when the market traded there, because narrative tells you we've rejected off here, we've broken structure down, creating relative equal lows. So narrative is bearish, you're not looking to buy. That created the day's high. Therefore, when the market takes out this sell side liquidity during New York session, you will not be looking to trade the reversals. Because New York, the London open kill zone creates the high of the day. So long story short, after you have this scenario written out, take the screenshot and you paste it on your Notion, you will have to then get as many examples of this same scenario as possible. That way you will have a lot of scenarios in your head and you will know the directional bias for the day. You will not learn it through someone telling you, oh, the market is going to go to the sell side liquidity or to the buy side liquidity. You will learn it through experience and having seen what happens with the highs and lows. This phenomena, it repeats itself numerous times in any given week, and it will be helpful to have examples. The only way to become experienced is by practicing. Cool. Another example is here. We took out the Asian highs, and then we broke down, creating a fair value gap, traded onto it, and then we targeted the sell side liquidity that rests below here. So that's 2 days that the same phenomena occurred. Take out the Asian highs, we drop lower. Take out the Asian highs, drop lower. And that happened during London open kill zone. Right there. The same session, the same phenomena. That's not a coincidence. I also have the same thing that happened over here. We take out the Asian liquidity highs. I'll just turn them on. See the Asian highs? Take them out. Drop down lower. This will act as your breaker block. And this is your fair value gap that broke structure to the downside, creating relatively equal lows. Traded up, hit it, dropped. And then the following breaks or structures lower, we can use the last up close candle and take out our trades during New York. So in this scenario, London open kill zone has established itself as the high of the day. You will not be looking for reversals during New York because a higher time frame liquidity was swept, the Asian and also the Asian session of this day. Those two got taken out, and therefore all the bullish PD arrays, they will fail, and they will act as liquidity. Whatever PD array fails, like this fair value gap, we give a reaction and then we drop through. The reason is because higher time frame tells you otherwise. We have hit our higher time frame objective, dropped. We're not going to have any reactions from here going higher than this high, because this high caused the structure break. This movement therefore can be considered as a sweep of liquidity, and then these drops can be considered as your breaks or structures. Therefore, if this break or structure occurred, you are not going to see the fair value gap, and these, they are not breaks or structures, they're liquidity grabs on the higher time frame. And you could be taking the sells from there, targeting the relative equal lows that are formed right here. So personally, I trade market maker buy or market maker sell model with guidance from the higher time frames. The examples for this typical trading method is have a higher time frame objective that was met, market reverses and gives me a high risk reward trade. I normally catch the big reversals from the inception of the idea. I catch them and then I wait for areas of liquidity to be met on higher time frames. So the correct implementation of market maker buy model, like here and like here, will give you the highest possible risk reward. So whenever I post trades on Discord, they will most likely be influenced by higher time frame PD arrays or high time frame structure, sorry, high time frame liquidity sweeps. So I'll give you an example. Say I took 1 to 2 trades a week, which I do, and I'm looking for at least 1 to 4 risk reward, which is logical because I expect to witness the break of 4 hour structure when I'm already in the trade. Like I'm already in the trade from here, I'm expecting the break structures on the 4 hours. For this example is this high. Even these highs can be considered a structure. So I normally target the previous day's highs or previous day's lows when I'm implementing the market maker buy model. And the reason I don't do continuation trades or I don't catch continuation trades is because in the previous years I've learned the most valuable lesson, which is you have to minimize the amount of times you expose yourself to the market. The higher, the more you trade, say like catch all of these retracements down, down. See, the more you engage in the market, the more likelihood that you will have, the more probability of you succumbing to human error, and therefore, once you get that loss, you then start revenge trading, and then probably blowing your account. Also, there's a huge amount of risk that's accompanied by entries in the market frequently, expecting. I mean, the market is gonna go lower, but you probably have 2, 3 entries up here waiting to target this low, and you can't really swing that because you don't know when this retracement, when this impulse will come to an end. So you'll be just hoping to go lower and lower, and then market rebounds like this. And you have, because you on the left hand side you don't have any objective. So let me not overlook the significance of having trading rules and parameters in place. For instance, if I encounter like 2 consecutive losses while trading a particular setup of the market maker buy model, market maker sell model, I will stop trading for the day, for the rest of the day, because that will probably mean market doesn't really want to reverse or doesn't want to do anything that is interesting me at that moment. It is crucial also to adjust these rules differently when trading accounts that have varying risk parameters. If you're trading account with 0.25% risk, you're going to trade it very differently to when you're trading a 0.4 risk, which I'm going to be doing, and I'm probably going to tweak that rule of not trading, not taking 2 trades, not trading a third time if I lose the. I said was when the market comes back down to the this last candle, it would go through it because it forms relative equal lows with this low of this week. So these 2 weeks lows form relative equal lows. And what I said was when we have relative equal lows, we often get price going lower then to revert back up. So I had this level in mind, and my last level in mind was around here, and we'll look at it in a few minutes. The reason this level didn't work was price came rejected out of it, but failed to close above this fair value gap right here and form any structure shifts on the lower time frames. So this area was out of the question. So what market did was he used this FEG right there, only hit the open of that FEG, and then dropped lower, and it was dropping down to here. Also, the timing aspect of this was not right because it started going there during the 9 a.m. and the Asian session highs were here as well, and market was just literally creating liquidity since it went inside the fair value gap. So I was not looking to 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 buy and wait for a sustained move higher. Okay, so this is where the idea was birthed. In this area we have, I think, the Thursday open price and also the Friday open price. The area they converge in is colored in that gray area, and we can go down to the lower time frames and see what's happening. Okay, so why did I select this area? First of all, it was during a Thursday, and I don't think it's a coincidence that market came down on the same day, the day before the last day of the week on a Thursday, comes and mitigates that area and rejects out of it. Okay. Another reason I chose this level was because market manipulated the highs and manipulated the lows, and a decision was taken here to create a new higher high on the market, going above these relative equal highs. So this area is quite important, and I don't think market would just go beneath it. Also, we've had this huge momentum down, and we had a 1 hour fair value gap right here. The confluence of the Thursday open price and the Friday open price coincides with the lower quarter of the 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 fair value gap. So it took an hour or so to go beneath that level and purge the lows. Look how long it took to fill. It took almost 21 hours to fill that level. Once we break it, we confirm a break of structure because we abruptly go above it, and then we come back down, mitigate this level of order block, and then market creates new highs. We we have New York kill zone lows too. So if the market decides to go beneath this level, it will probably manipulate the lows and tap into that level. So that's what I was looking for. And also we have this last down close candle prior to the up move. This can be considered as your order block. It also takes out the sell side liquidity of the bottom side. It doesn't close beneath it. Therefore, this is a manipulation of the lows and a break of structure above this high. We've also had these relative equal lows during Asian. We manipulate it, break higher, come back down, mitigate this down close candle, and mitigate this down close candle. So we can use this as your bearish order block on the 15 minutes. So that's the area I had in mind, and I wanted market to go there during a certain session, give me structure shifts, and then I'll be placing. I took my trades off that. Cool. Let's go to the right hand side and see what's happened here. Okay, we wicked that level, broke structure. Can you see the bodies of the candle? We're not. We're closing above this candle's body. That signifies strength in the market, and it signifies a break of structure. I've had my entries, and I was looking at this 15-minute fair value gap right there. This is your swing low. A swing low always has a lower high, sorry, it has a higher low wick
and a high low wick to each side, and this forms the swing. Likewise, this is a swing high right there because it has a lower high and a lower high wick to either side. So this is your swing high, and this will form your London Open kill zone highs. Okay, so the start of the day, this is the area I was expecting market to move from during the start of the week, but the timing aspect didn't really line up. You see, it goes lower, yet doesn't give you any re-entries to go higher. It was just rebalancing the fair value gap that I mentioned. Cool. Also, it creates this Asian session range, and we start going beneath it. Remember what I said, what happened during the previous days? We always find the market consolidating around the Asian range. It takes out the Asian highs, liquidates it, and then goes lower. For this day, for some reason, the Asian highs were kept intact, and then we just drove lower because our objective is to go here and then liquidate the Asian highs later in the day. Okay, so let's go down to the 5 minute and see what's happening. Okay, the 5 minute, we wick that level, and also remember this level is your New York kill zone lows to your far left hand side. We wick that level, we break structure, and then we break structure. Okay, see it as this way. Who's making money in the morning? Because what the market does is it punishes certain amount of people that are making money when they don't move their stop losses. And it doesn't really know where your stop loss is, but all it knows is it will engineer liquidity above highs and above below lows, and it will revisit those levels. So who's making money from the start of the day? The sellers. So where could they have their stop loss if they were selling? Right here. These relative equal highs that form the London kill zone highs. There's liquidity that's resting here. Okay. Also, they'll have their stop losses above the Asian if they were selling during here. Cool. And can you see this high over here? It drops. This forms relatively equal highs with the New York kill zone high that was formed right here. So what it does is it manipulates the people that want to buy first. They get in the buys again, and look what happens to the lows. These guys are given hope that it's going to go lower by breaking this low. Takes out the early buyers. Cool. What does that intrigue then? It intrigues all these sellers to put their stop losses above this recent high because it took the lows. So they're expecting the market to continue going down. But what do we know? We know we achieved a high time frame level. We're taking liquidity. We exhausted all the liquidity to the left hand side. So we'll be targeting the buy side liquidities from this point onwards. Cool. So these guys got taken out by this movement up, and we created a bearish order block. This down close candle prior to the up move, and we also created this bearish order block. And as you can see, my entries are based around here. Cool. So what happens here? We still make higher highs with the candlesticks close. So we're breaking structure. But we're still engineering liquidity with the wicks. So they keep putting their stop loss above here. Market gives them hope. When it comes here, they're expecting the market to go and break all the lows. But what happens to them? Market comes back up again, gives them hope still, and these are all quadruple highs. So whoever was selling from here has moved their stop loss above here. and the market doesn't want to target any of the the buyers because they already took them out here. So now is the turn of the sellers to be punished. Okay, create quadruple highs, and then this explosive movement up, and this explosive movement up takes all of them out. You see how the market doesn't come back to this down close candle because he doesn't want to give these guys a chance to exit the their trades with break even. He wants to punish them even more. So the algorithm keeps price above that level. Okay, and then it revisits that level in the future during here, and it taps into that bearish order block here. Okay, but it punished them already because look, it went above that level 50 pips. Who would have their 50 pips, extend their 50 pips to here? Who will do that? They'll probably have a 10 pip stop loss, and the algorithm would take them out. Okay, let's go down to the 1 minute time frame, and I'll explain what I saw during when I was taking the trade. So remember, this area is your area of 15-minute fair value gap. What I saw was this drop down and this aggressive movement up. This is your structure shift. I'll just put an arrow into it. So that's your structure shift, explosive movement up. I entered a trade around here, expecting the market to, or the price to, essentially close above this fair value gap. But I closed earlier as a break even because I realized that price will be more aggressive, and we have obviously news for the price to be aggressive. So I waited until we closed above this fair value gap. I closed above it, and as you can see, we are manipulating the lows all the time, and we're respecting this fair value gap right there. We're respecting the fair value gap, and we're manipulating the lows at the same time, and we're not closing beneath this fair value gap. So that tells you there's underlying strength in the market. And what do we form all the way here on these highs? We're forming relative equal highs from here down to here. They're all bunched up like this. So when the news got released, I saw this break up. I saw the retracement down to this FEG. I took the trade from here. The screenshot was taken that I showed earlier when the market moved around with two candlesticks like this. I took the screenshot. So if you have saw this market create relative equal highs and drop back down, you could have had the entry of the breaker block, which is situated around here. I'll mark that as red. That's your breaker block, because the reason is what it did was it broke beneath that level, and then we broke above it. So this was act as your breaker block, and you will not expect market to come down to here. So what I did was, when I saw the market create this high then drop back down, I immediately started moving my stop loss to break even, because I knew this breaker would hold price up. Furthermore, inside the breaker, you have your inversion fair value gap, the fair value gap that led price to create this structure shift. Because look, we create from this swing low to this swing high, we're trading down. So whenever this low gets taken, we treat that as a breaker structure. Treat that as a breaker structure, and this is very important because it calls that breaker structure down. Don't worry if you don't understand this part, you understand it with when you have enough experience. Look, breaks or structures occur on the premium side or you're expecting the break of structures to happen in the premium side of the curve when you have the low to the high. So you're expecting market to trade down like this. This would be taken as a break of structure, and we're just trading into the, remember this level was your order block. We're expecting that to trade. So price would remain bearish until it says otherwise, which was here. The break above this high, and we tapped into here and we dropped. From here, we tapped into those 3 consecutive down close candles, which are your bearish order block. We prepared price up. So this is your breaker structure when we got above here. So if you're conservative with this approach, you could have been taking the buys from here if you didn't have your buys already down here. And you can see create this fair value gap. We trade above it, uses an inversion. We trade on it, and we don't need to come back down to here because we already took out the sell side liquidity from this low. Look at that low, take the sell side liquidity, trade above it, use this level as inversion fair value gap because price didn't, or price meant to have created down close candles and it went up, but it went through it immediately. So we will trade on it and use it as support for simpler terms. Furthermore, this is your breaker. Why is it your breaker? Because yeah, let's have the 3 candles. That's your breaker. The reason is it was the last movement up that took out liquidity. Price failed to go lower from there. So this it will act as your breaker. When it acts as your breaker, we create relative equal highs with this, that, and also here. So all of these, there's liquidity resting above here, and market would initially go higher. Why would it not come down lower? Because we took out the sell side liquidity. We sweep the lows. Therefore, what we're going to do is we're going to break the highs. We sweep the lows here, right there, and we break the highs with candle closures. We break above that body of those candles. They will act as your breaker. We come back down, we sweep the lows, we tap into your to this level, which is your fair value gap that is inverted. Therefore, this gap over here will be used as IOFED, which I covered in the last commentary. It doesn't have to be filled all the way because we have a breaker. So if we have a breaker and a fair value gap, we will probably fill around the upper quadrants of that fair value gap, which is up to say 0.75, and will not probably reach the level which is 50%. You see that? That's IFED. This area will be left as basically a breakaway gap. Market does not have to trade into here. It can just use the upper quadrants of it to achieve its high time frame targets. Okay. And remember the timing aspect of it as well. The New York session was closed during at 10 o'clock it closed. Therefore, this is your low of the day. New York creates your low of the day, and this is your high of New York. So whatever is near the high of New York and the high of London will be used as liquidity. Sorry. So yeah. So you have to know this level as well. This level is your previous day's lows. So once we take out the previous day's lows, we're also bearish, and we need to We need to get immediate rebalancing of this whole relative equal high situation that is formed during the latter part of that day. Okay, let's cover the timing aspect, which I nearly forgot. So this day opened here, we dropped down lower. ICT says if your bias is buying for the day, you need to be buying below the daily open price. If the market is not trade has not traded above the daily open price by 8:30, which is the case for this trade, the 8:30 open price is here, you have to use the 8:30 open price instead of the daily open price. If the market creates that daily open price, sorry, the 8:30 open price, and we're still below it, then we're really, we're in discount. We're in a really cheap area to be buying from. So look at the 8:30 open price around here. We trade above it, we're in premium. We shouldn't be buying when it's up here. This whole thing, we shouldn't be buying it. Once it dips below it and starts manipulating the lows without going beneath here and breaking structures, and it's towards the end of the session, which means probably this low is protected because we manipulated this low out and we're breaking the highs and all of those things I mentioned before. As you get the manipulation of those lows and you see the market getting respected on the 8:30 open price, you can buy close to 8:30 open price or a bit above it. In this situation, I bought above it. When I saw the structure shift in the 1 minute time frame, I took the buys. And the targeting was quite easy. It was the previous day's highs, which was here. See, this is Wednesday's price action. I think Thursday is around here. Yeah. So I targeted the Asian session highs and this high specifically because that's all I needed to target to get my to pass my funded FX challenge. Okay, so that'll be the end of the video. I hope you learned something new and always keep practicing. Peace.